Cathie Wood is as infamous as an investor can get. Almost overnight, she became an internet sensation who captured the hearts and the attention of millions of retail investors who had thrown their life savings into what they saw as the future of the stock market. She gave legitimacy to the bulls who made up the Tesla cult. She came out with her own predictions of Tesla reaching $4,000 a share pre-split, and to everyone in Wall Street's surprise, she was vindicated. She pushed her success even further than that, doubling down on her previous convictions, betting big again, this time on technology that she claimed was going to change the world, and she just so happened to do it at the perfect time. The pandemic led to a massive influx of capital into the markets, along with millions of people who were stuck at home, unable to work or spend their money, but still getting a paycheck every month, so they threw their salaries into the markets and they bet on the exact same technology as Cathie. Zoom, DocuSign, and Teladoc, companies that were destined to do well in a world where everyone is locked away in their homes, and they did do well, and so Cathie did well as well. More recently though, Cathie has not been looking so hot. The last 6 months especially have been very poor for her fund, and almost every single pick she's had has been declining. To be perfectly honest, if it weren't for Tesla maintaining and even reaching new all-time highs during the latter half of 2021, she would probably be little more than a footnote about investors of the past. Today though, Cathie has made a new target. Ford and General Motors, legacy car companies that she is claiming represent the largest bubble in the markets right now, the greatest threat to financial stability, and just maybe her own ARK Invest Cathie Wood's big short. But before we get to that really quickly, make sure to leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. Now let's see what Cathie has to say.
What's going on here? Well, it could be a combination of consumer sentiment not being happy about what's going on, and a consumer preference shift towards electric vehicles. That is why at the CES show, the Consumer Electronics Show, you heard these auto OEMs talking more about electric vehicles. Of course, it was the electronics show, and we saw that Ford's F-150 Lightning, that they were going to have to double production given all of the demand. Well, what they don't tell you during those appearances at CES and so forth is that electric vehicles make up maybe 2 to 3% of their sales, and that 97% of their revenue bases are gas-powered vehicles. And it's probably 90% plus of their production now. If there is the combination of the consumer turning off, not wanting to spend as much money, certainly not on big ticket items, and a preference shift, if they're going to spend, they're going to spend on electric, then these OEMs have an issue. They have a problem. And we think we're going to hear more about it in the quarterly reports. And we hope analysts start asking about it. Now, I look at the performance of stocks like GM and Ford. They soared on those electric vehicle announcements. Think about that. That's ridiculous. It's only 2% of their sales. And what if the other 98% or so forth are on their way out as the consumer preference shifts toward electric? They have problems. They have problems because their gross margins, depending on the company, are somewhere between 10 and 20%. Those are very low gross margins. And if you look at the Bloomberg estimates for this year, 2022, after a very weak 2021, you see growth estimates in the 10, 15, 20% range. The US-based ones are at the higher end of that. Well, that may not happen. And again, they don't have a lot of room for error. And we have seen them pivoting and announcing that they're pivoting ever more quickly towards electric. But the problem is almost 100% of their base is going to go obsolete over time.
So what Cathie is basically saying is that there is a bubble in the markets right now, and it is in vehicle companies, and it is even related to EV stocks, but it isn't Tesla, it isn't Nikola or Lucid or any of the other exclusive EV car makers. It's with legacy car makers who are only just starting to break into the EV market. Now, what she's actually saying is really twofold. Firstly, that companies like Ford should not be jumping up in value simply due to the limited number of Ford F-150 Lightning and Mustang Mach-E's that they're going to sell. But secondly, that actually the rest of the vehicles that make up these businesses, they're going to stop selling and those sales will disappear as well as consumers shift over to EVs. Now, she makes this argument in a couple of ways, by looking at the monumental growth of EVs and the fact that traditional vehicles, those with internal combustion engines, are not going to grow at any kind of similar rate. Now, the idea here, again, is sound. EVs in the long run are going to win out. It's clear, if for no other reason than the fact that fossil fuels will continue to get more and more scarce, and there will come a day when there isn't enough oil to fuel our demands today. On top of that, the economy that we're seeing today is changing, and consumers are spending less money than they used to, and dropping $50,000 or $60,000 on a truck is just going to get a little bit less common. At the same time, EVs are looking more desirable. Their ranges are increasing and they're cheap to run, and they tend to just be quite nice as well. Cathie's argument here is basically that soon enough, everyone in the world will be buying EVs as opposed to traditional vehicles, and legacy car makers like Ford and GM are just not going to be in a position to cater to that market, and they'll see their sales collapse by as much as 98%. Cathie is telling us that these companies are basically the walking dead, that their valuations are far too high considering the reality behind the car market today. But according to Cathie, it does go even further than that. Now, while you've been watching my videos, your paycheck became worth almost 8% less over the last year. That's the real impact of inflation on your earnings. Now, obviously, I'm trying to be a bit dramatic here to make a point, but it's an important one. Instead of whining about Washington or the Fed, I'm a big believer in taking back control into your hands when it comes to your financial future. Now, that's why I did some research and I came across and partnered with a billion-dollar fintech startup called Masterworks.io. Now, I think what they're doing is genius, and I'm going to keep telling the world about it. Masterworks.io lets you invest in blue chip art, an asset class that's appreciated 23% annually on average when inflation is above 3%. Their team of art experts analyze over 60,000 data points to find trending artists with high potential for growth. They then purchase these paintings by these artists, and after they go out and buy them, members can purchase shares representing an investment in those artworks on their platform. Since its inception in 2017, Masterworks has successfully offered and sold 2 paintings from its collection, each realizing a net annualized gain in excess of 30%. So join over 300,000 other members on the platform by using my special link in the description to get priority access today.
Where the bubble might be in this market, it is not in innovation stocks. They've been cut in half, many of them, some by 75%. But listen to this. I gave you the story about Ford reporting that it would have to double its electric vehicle production of the F-150 Lightning, and the stock just taking off, not paying any attention to the auto statistics I just mentioned. Well, when I think of what could happen in that space, and I see these stocks ramping on sales that mean nothing to these companies in terms of their earnings, shall we say, right now. In fact, they need to invest a lot more in electric to make it happen and to move the needle in these companies. But what if we're right and there is not a 20% increase in sales? Maybe sales are flattish year to year. That would put them at roughly 15 million units. And they'd probably have to start cutting prices if we're right on the used car market and the pricing there, which means they're probably going to be facing some credit issues since they're hugely leveraged to the credit that people take out on their autos. And as prices go down, residual values go down. And, auto credit was the best performing credit in 0809. And so there's a lot of complacency in that market. In 0809, the homeowner had to decide, okay, I can't pay everything. I'm out of work. What do I pay to just keep things going? Well, they were going to pay their auto loan down and default on their mortgage because it would take a while for them to get kicked out of their house. But they needed to get to their jobs. Today, that would change because of ride hailing. So we think that complacency is misplaced and that the auto credits out there could become a mess. So if I'm right on any of this, there will be disappointments in terms of the auto sector. And I wouldn't be surprised if at least one of the companies loses money next year, which would be most unexpected. And if it loses money, what is that valuation? Where are the crazy valuations now? Are they in our stocks? Now that Zoom is down to 33 or 35 times this year's earnings? Or is it in an auto stock where there might be losses? And what's that PE ratio? That's infinity. That's where the bubble is. And I think you're going to see a lot more cases in point as this year moves along, and the innovation that we see evolving so rapidly, DNA sequencing, transforming healthcare, robotics, solving the labor shortage problem we're having, energy storage, the consumer preference towards electric, uh, um, artificial intelligence, which is the glue that is helping all of these technologies converge. And the last one, blockchain technology. We think that we're in a period of innovation that was the dream in the late 90s. But those companies were vaporware. They were based on nothing but eyeballs. We have real revenues. We have incredible growth rates.
So what we just heard there was Cathie making practically the same argument, not just about the auto market, but about almost every single industry around. She's making the argument that Teladoc will disrupt the medical business and cause hospitals to go bankrupt. That Zoom will make corporate real estate, offices useless, and REITs will go bankrupt. That robotics and blockchain technology and AI will be so revolutionary that they will cause so much innovation that every company that exists today and doesn't embrace those new technologies, that within a few years they will see their revenues dry up, their consumer bases disappear, and their valuations crater. Now that is a bold claim, no doubt, but Cathie is used to making bold claims, and while I don't think anyone would claim she was successful over 2021, 2020 was a different story, and she clearly got a lot of things right then. It is here though that I have to bring us all back down to earth, that I have to return to my realm of practical skepticism and maybe put a damper on the future that Cathie claims we are about to enter. Now the first problem here is that the presence of one bubble doesn't necessarily mean that there is no bubble somewhere else. Now I actually agree with Cathie when she specifically says that Ford is overvalued right now, because frankly it is. It's a legacy car maker that has tight margins on a good year, and on a bad year it can lose billions. That's just the nature of the auto industry, and it's why most auto manufacturers tend to run at very low price to earning ratios of something like 5. Ford though has seen an EV boost over the last year as retail investors flock to the stock on the idea that the Mustang Mach-E and the Ford F-150 Lightning will be huge successes. Now Cathie is right that these cars make up about 2% of their sales and they should not be dictating the valuation of the company, yet they are. The problem here lies with the fact that there is also a bubble in EV stocks, and that Cathie is making this same logical fallacy with the rest of the stock market as well. Just because some consumer staples are overvalued, that doesn't mean that online retailers can't be as well. Just because traditional industry stocks are overvalued doesn't mean that Zoom and Teladoc aren't as well. If you're new to my channel, then maybe this is news to you, but we've been talking about the everything bubble for months now, and it's called the everything bubble for good reason, because it represents a bubble across countless different asset classes, countless different markets and industries and countries, and it's all driven by loose monetary policy that central banks all around the world have been using to inflate asset prices. Companies valued at 50 times their sales based on the loose idea that one day they might change the world should not be normal, and there certainly shouldn't be 20 other different companies all valued in that same manner, all fighting over the same customers. The simple fact is that there was a bubble in tech stocks, and actually there still is. If we look back to the dot-com bubble of 2000, which Cathie herself likened to today, we can see very clearly that the frothiest stocks got the craziest valuations, but the rest of the market grew to be overvalued as well, and while the pets.com fell first and fell the hardest, just as the pelotons have done over this past year, the rout in risk on assets spreads, and it starts to hit the rest of the markets as well. It took over 2 years for the dot-com bubble to bottom, and by looking at today through the most lenient lens possible, at most, we are just under a year into this bubble popping as well. It's clear to me at least that the pain is not stopping anytime soon. Now Cathie claimed that as inflation subsides, her innovation-based companies will thrive and the rest of the market will suffer. But Cathie has been wrong about inflation more times than you can imagine over the last 18 months. At every possible opportunity, she told us that it was transitory, that it was overstated, that it wasn't a real threat, and that before long it would all be a distant memory, but she was wrong every time, and I find it hard to believe that the same arguments that she's been making over the last 18 months, which were wrong then time after time, are suddenly going to come true this time around. Inflation isn't subsiding, which means interest rates are going to go up, as are bond yields. Debt servicing will get more expensive, and companies reliant on capital to drive growth that is necessary to justify their valuations, well, those valuations will fall and Cathie's bubble will continue to deflate. The sad, simple, hard truth here is that the everything bubble has already popped. It's already started to deflate. You just don't know it yet. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world-famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up. You don't have to buy anything. You don't have to hand over any card information. So if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Personally, I'm holding about £55,000 right now in cash on stablecoin sites like BlockFi. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.